Today's topic is the AGM, and it's a critical part of the governance structure for quoted companies. And so I'm delighted to welcome Cas Sydorowitz, who's a good friend of Fidelio, who's the global head of Activism and M&A at Georgeson, to help us think through what the last AGM season looked like and what's likely to be coming up on the next AGM season. And I'm also joined by my colleague, Alistair, who's head of ESG and strategy, who'll help us think through some of those issues, no giveaway that ESG is likely to be quite a large part of the themes that we're talking about. Next chart, please. The AGM comes up very frequently in the work that we do with boards. Obviously on the board evaluation side of our work, we're looking at how listed companies, how listed boards navigate the AGM system and achieve alignment with their shareholders. But also on the search side, it's a really important consideration in board search. If we flip to the next chart, please. And I thought it helpful, before we move on to Cas, just some of the themes that we're seeing, in particular on the board evaluation side. Firstly, that the AGM is an absolute and important component of every board evaluation that we undertake and for listed companies. And it's a mechanism for thinking through the relationship with shareholders. Secondly, and I think this is really important, that the chair and committee chairs are really demonstrating a willingness to engage with shareholders, and this has increased quite significantly. I would say, however, that this isn't always reciprocated, and this may be something we want to touch upon with Cas, that companies are seeking to engage with shareholders, and the pathway to do so is not always clear for boards. Thirdly, that we see boards taking a much stronger interest in the quality of engagement at an executive level with shareholders and stakeholders. And so really, being aware of who's conducting investor relations, how it's being conducted, what's being said, expectation management, sort of the nuts and bolts, and not getting involved in it, but absolutely understanding it and reassuring themselves that there's a good quality engagement there. Fourthly, and I know Cas will be talking about this, we are seeing that activism has become multifaceted, and boards really want to understand what is likely to be on the investor agenda, and they are aware that this might come from different angles and multiple angles. And so understanding that complexity is really very prominent on the board agenda. And then the fifth point, which I think will be no surprise, many boards are quite frustrated with the influence, I guess, that the large proxy advisory firms have in terms of voting, and the ISS and the Glass Lewis, and how they can engage and influence that process. And I think that will be something that Cas might be able to come back to as well. Thank you. And if we could move to the next chart, please. So now we're going to have a poll question, and it is quite complicated, but I'd love your feedback on this. What do you think is going to be the key theme at the next stage or AGM season? 1, rem and remuneration. 2, financial performance. 3, climate change. 4, diversity. 5, the whole supply chain. There are many angles to this. And 6, social responsibility, in particular in the context of the cost of living crisis. So 6 choices there. And I don't think the panelists can vote, Cas, I'm afraid, but no, we can't vote, but everybody else can. So Amy and Belle, if you could perhaps tell me when people have been able to vote and share the results. Well, it was a complicated question. I think we've got a complicated response. So I think 35% think that financial performance will be the most important issue at the next AGM. 30% social responsibility and the cost of living crisis, followed by 10% on climate change, 10% on remuneration. Well, that's quite interesting. 5% on diversity, and 10% on supply chain management as well. So actually quite a distribution there, which I think probably sets us up quite well for Cas's overview. Next chart, please. In fairness to Cas, I asked him to focus on, I sort of gave some direction here, and I think you'll get more breadth than this. But I asked him to really reflect on three areas. One, say on climate and the resolutions that are being proposed by boards, but also by shareholders. Also, executive remuneration. And thirdly, director elections. And I know Cas has recently published a report, and these were three themes that came out quite strongly. But I'm going to hand over to Cas to take us through what happened in the last AGM season and some thoughts going forward. So Cas, welcome, and over to you.
Thanks very much. It's a pleasure to be here, and always a great fan and good friend of Fidelio. Next slide. Georgeson does an annual season review looking at the largest companies in each of the major 8 markets across Europe. Today, I'll be focusing on the UK market. And I think one of the key themes that is the starting point for this year's season, it was the return of physical shareholder meetings. And that had a very specific relevance for many companies. The annual meeting, first time people came back and were meeting in person, that AGM was used as a stage for several activists. They used it as a way of garnering attention, media, headlines for their causes, and we saw very significant disruptions at several large companies. Equally, some companies took great precaution to ensure that their meeting wasn't disrupted. So those companies had comments from shareholders challenging them or asking why security was so high and necessary. I think some of the headlines garnered a few weeks later kind of answered that question for many shareholders. I do think that this will be an issue that companies will have to face going forward. We saw things such as shareholders gluing themselves to chairs, rushing the stage with posters and whistles, even chaining themselves together. If you imagine, I was at one shareholder meeting where you had to go through a metal detector and you had to put your handbag or any attaché through an x-ray machine. So kind of hard to imagine someone coming in with a big reel of chains and padlocks, but nonetheless, some of them did get through. Next slide. There's a wide array of vote turnouts here. This is only looking at the FTSE 100, and so we have, the average turnout here was 74.5%. You had some very high participation levels. Those were driven by companies that had very significant shareholder base. Some of the ones on the left-hand side of this slide with a very low quorum were driven by a number of factors. One element is high retail ownership, widely diverse share ownership base, and listings in other jurisdictions, whether that's ADRs or secondary listing. That can have an impact if the shareholders in the other jurisdiction don't participate, and that level of ownership in those other markets is significant. So that can have a material impact. A low vote turnout, just for everyone's purposes, it never looks good if you're below the 74.5% average. The other thing it does is it creates an opportunity for an activist or multiple activists to put pressure on the company and garner greater support than they otherwise would. And so if you have a 50% vote turnout and a 5% shareholder who has a cause that they want to progress, then they will have a 10% impact at that shareholder meeting. And if they get other shareholders to support them, that number grows. And so the risk factor for companies with low vote turnouts is even higher. I would just warn people that 74.5% was a slight dip from last year, 74.9 in 21. And while there's no reason to think that there's going to be any significant decrease in 23, I would just add a word of caution. There's a lot of pressure, mostly in the United States, on large index managers, notably BlackRock, Vanguard, and State Street, but others as well, dimensional fund advisors, legal in general, to divest the voting authority for their clients back to their clients. If that were to happen, and we suddenly saw BlackRock, instead of voting 5 to 8% of your company stock, only voting 2 to 4%, your ability to get your average, participation level at 74% might be quite challenging, especially when some of those large investors are voting portional positions. Next slide. This is the every year we look at what issues, unlike the investor forum who has a sin bin list that looks at 20% opposition, we take a bit more critical view and look at 10% against votes, kind of on an annual basis. And while the most number of opposition votes falls into director elections, it represents a fairly small percentage of the overall number of director election resolutions. However, if you look at remuneration policy, we saw a big uptick this year in opposition votes. So there's a small number of companies that have put such a resolution to a vote, but there was a high degree that got more than 10% opposed. Part of that comes from, if we jump to the next slide, support, or let's say opposition from ISS and also Glass Lewis. Some of the reason behind ISS's opposition came from the focus on bonus and LTIPs. Some cases, the company didn't provide any or sufficient rationale for why there was an uptick. Other cases, the order of magnitude was deemed as too great by ISS. I'd just like to add that ISS in the last 12 to 18 months have changed ownership. They're now owned by Georgeson. Not everyone knows that. We progress to the next slide. Glass Lewis also changed ownership March 21, and they're now owned by Peloton Capital, which is a private equity company. Glass Lewis opposed REM policy more often in 22 than they did in the last 2 years, very significantly, almost a doubling, more than doubling this year. I just flag for this audience, as you're going to prepare, for any company who's going to prepare for a REM policy vote next year, not only do you need to do engagement with your investors, but to really do a deep assessment on what issues did ISS and Glass Lewis oppose this year and why, just so that you can avoid running afoul of some of those same issues. If you go to the next slide. There's a lot of very small lines on this chart, but I will summarize it for you in terms of the impact of ISS and Glass Lewis recommendations. It's very clear that those companies that had against recommendations from ISS and Glass Lewis had the lowest vote support in terms of their remuneration report this year. And that's not a surprise. It's been true for years past as well. We see less impact from IVIS and PERC, and PERC, hardly recommends in favor of any remuneration reports. That their chart in the lower right is almost entirely red. It's not exclusively red, but for the most part it is. PERC, often has a small to de minimis impact on the voting outcome. Not that they're not important, it's company specific. Their clients, PERC's clients, are largely local authority pension funds, and it depends on how many shares are held by that audience in your share register, which will determine whether or not PERC is meaningful. Next slide. Actually, we go 2 ahead. And the next one, thank you. Say on climate, just went back one more, I'm sorry. Perfect. Say on climate resolutions can either be put forward by a company or by a shareholder. We're seeing a growth in the number of say on climate proposals across Europe, not just in the UK, being put forward by corporates. This was largely initiated, interestingly enough, by TCI and Chris Hahn in 2020 at AENA in Spain. It's the airline company. And a number of companies kind of followed suit that same year and have continued since then. I would just put a word of caution, whether or not we will see as many companies doing so in the future. And that's partly driven by, not that the need isn't there or the disclosure requirements aren't necessary, but I think shareholder expectations and what they're willing to vote for or against is starting to shift. And there's a number of factors affecting that, which I'll come on to. Next slide. So in 21, the average support for a company-sponsored say on climate was 97%. So a very high level of support. You'd expect that. It's coming from the company, so it has the board's blessing. This year, it dropped down to 91%. That's a relatively significant drop. And that's part of the reason why I think companies will start to question whether or not they put this forward themselves. The other issue is that companies that had resolutions, say on climate resolutions in 21 and 22, very similar resolutions, they saw a drop of 95 to 88% support. So again, the overall level across the market is dropping, as well as the per company when it's year-on-year analysis. Glencore was the first company to get below 80% on a say on climate resolution this year. I think it's a big deal. Glencore had other challenges with respect to a shareholder activist in their register and pushing for change there. Companies are asking about the future of such resolutions, and is this appropriate given the changing views of some of their shareholders? Go to the next slide. Glass Lewis is an outlier. So on the left-hand side, we have ISS last year versus this year and their level of opposition and support. So there's a lot of green on those bar charts on the left. On the right-hand side is Glass Lewis recommendations in the 2 years. And there's far more red and amber on theirs. Go to the next slide. So here are a couple of shareholder resolutions on ESG specific issues. There's two types of companies that are being targeted in 22 by NGOs. In this case, there's two different NGOs, Follow This and Market Forces. There are oil and gas companies, which you can understand and see immediately why they would be targeted. The other is financial services companies. And the reason financial services companies are being targeted is because they are creating the finance, doing the lending, and supporting companies that are either in the extractives industry or oil and gas industry. And the objective is if the financing and the insurance runs out, there's another NGO called Insure Our Future, who is targeting insurance companies. They want insurance companies to stop insuring mining companies that dig coal out of the ground. So just another NGO, but it focused on the financial services and very specifically the insurance sector. The support from Follow This on their two resolutions in 22 went down on BP and Shell. Again, I think part of that had to do with changing investor views, with some of the windfall profits from the war in the Ukraine and the oil companies kind of benefiting from that. I think that's putting a pause on some of the climate transition activity that we're seeing in different jurisdictions, both by companies and kind of political views on the order of priority. You go to the next slide. On the S side, so E, S, and G, environmental was the previous slide, focused on carbon-intensive companies. The S here is social, and Share Action was the promoter of two of the three that we see on this list. The HSBC one was down to a very specific corporate action previously. At that one company, it's not a widespread issue. It was very unique to HSBC. They got Share Action as an activist, got more vocal this year. I expect we'll see them even more vocal next year, and I'll tell you why in a little bit. At Unilever, they requested the company to improve the mix of sales coming from healthier foods. Share Action withdrew that resolution upon negotiation with the company when Unilever agreed to report on the healthiness of the food it sells. So Unilever, as many of you will know, had Nelson Peltz elected to the board there. Nelson Peltz is the founder and the principal at Trian, a very large US-based fund manager who ran a $100 million proxy fight at P&G a number of years ago. I suspect Unilever wanted to avoid that massive cost and invited Nelson on, I'm sure after long discussions and negotiations. Sainsbury share action went to a vote. They actually did reasonably well as in terms of level of support. They wanted the company to commit to paying a living wage to their employees. Again, I think this topic is going to come back up next year. The kind of living wage, the dislocation of the workforce, and the pressures on them from inflation, mortgage rates, the ability to pay their bills, electricity and utility bills, is going to weigh heavily on companies, not just supermarkets, but in a number of sectors. Go to the next slide. There's a lot on this slide. I'll let you read it, but just I'll withdraw or pull out just a few points that I think are relevant. The war in the Ukraine has highlighted the importance of supply chain management and alternative suppliers. That is not going to go away, and there's even bigger pictures if we think about the supply chain and the customer base on a China-Taiwan dynamic, which is heating up, and there's all types of political maneuvers there. I think it's probably prudent for everyone on this call to have a plan in the drawer that looks at that specific eventuality. Not that I'm not a doomsayer and predictor that that's going to happen at all or anytime soon, but I think it's prudent to have that plan to hand. There's continuing pressure on asset managers to ensure that their ESG products are genuine and fit for purpose and not wrongly labeled. Part of the reason behind that is that ESG products comes at a premium, right? So if you are investing and putting your money or your client's money into ESG focused products, the investors, the asset managers, are charging more money for those specific products. So they want to make sure that they're not doing the clients a disservice by saying that it's doing one thing and not actually living up to the prescriptions or the descriptions on the tin. I said before that I expect share action to be more vocal this year. Part of the reason why is that they have a number of job openings that they're advertising for shareholder engagement on a number of thematic issues. It's not an automatic rationale that they will be more active, but why would they? It's an NGO. It's a why would they be hiring people if they're not looking to be more vocal at shareholder meetings? Don't forget, Share Action is the NGO that ran the shareholder army. I'll never forget that. I love their poster that they had on their website many years ago, where they were recruiting shareholders, retail shareholders, to join the retail army, and they would train them. They would train them how to attend meetings, how to register so that their name was on the register, how they could attend, what they should do when they got into the room, how to get up in front of or speak to the CEO or the chair, and then who to go speak to after you've had that conversation. So they're quite committed and they're quite clever. And I'll come on to the anti-ESG ESG movement in a moment. Go to the next slide. I won't spend a lot of time on this slide, but I think, while it probably wasn't necessarily the first, Stuart Kirk, ex-global head of responsible investing at HSBC, gave a speech hosted by the FT Moral Money in, I want to say it was April, maybe it was May of this year. It was within 1 month there. He challenged many of the working assumptions on the necessity to decarbonize and the opportunity costs associated with investing in any climate transition. What got him in deep trouble, and I think probably ultimately got him suspended from the role, was the totality of what he said. But there was one specific expression he said during that speech. It was his statement about Miami being 7 meters underwater in 100 years. He said, "Who cares if the Netherlands and Amsterdam survived, and we just learned to adapt and figure out how to deal with all that water." I'm not promoting that at all, clearly, but I think that was probably the thing that tipped him, the power base behind him to move him on. But he did ask a number of probing questions about opportunity cost and how we as a society, as humankind, adapt, and the models that are being put forward. He challenged those models to see whether or not they considered any level of adaptation, or we just took our current working premise and extended it out 20, 40, 50 years. I suspect there probably is a range of answers in that. Next slide. The one that's probably most interesting, it's still relatively small, is an investor in the United States, Vivek Ramaswamy, who is the founder of Strive Asset Management. He's created a number of ETFs, and one of which is focused on the oil and gas industry. He actively describes it as an anti-ESG fund. The idea being that he wants companies to focus on their fiduciary duty to shareholders, and the concept of shareholder primacy kind of overruling all other stakeholders in decisions that companies make. I think it's there's the discussion about shareholder primacy, been going on for a while. Vivek has written a book called Woke Inc., where I think he articulated a number of arguments cogently that has gotten people to listen to him. And I think him writing that book was an advertisement for Strive Asset Management. Strive has grown from its last time I saw it was $300 million of assets under management. It's not a lot of money. That grows to $1 billion maybe in 6 months, 9 months. Then it's starting to get more significant. He's written letters to Disney, Chevron, and Apple. Quite a wide array. Only Chevron is in the oil and gas sector, but some of you may be aware of what's happened with Disney in Florida because of Disney's comments in the political arena, and looking at LGBT and other issues has gotten them in trouble. And they've lost some of their specialist tax privileges in Florida as a result of their statements in the press. So Strive has written to Disney asking them to refrain from making political comments, so that just focus on their core business. Similarly with Chevron, focus on creating the greatest value for shareholders and don't make decisions based on ESG metrics, but make decisions based on value creation for shareholders. Kind of an important distinction. Next slide. I will just share a personal anecdote with all of you. Yesterday, I became a naturalized UK citizen. I'm very proud of that fact. I was the only American in the room swearing in, but that's fine. I was very pleased to do it, and I'm very proud to be a British citizen now. I have the certificate. I don't have my passport, but that's coming. And when people ask me, do you want to go back to the United States? I say, absolutely not. And this slide partly describes why. The United States has become so politicized, not just from, women's rights and a whole host of issues, gun rights. It's coming into effect how state pension funds allocate their money. And there is a wide array of states on either side of the political spectrum who are drawing lines in the sand and taking decisions about stocks they invest in, companies they do business with. The United States of America is looking more like a federation of states kind of going their own way on a variety of political issues. The issues I talked about, fossil fuel, also mining. The U.S. has a lot of coal mines in West Virginia and elsewhere. Energy, firearms is a dividing line issue. Just anecdotally read today, Republicans in Texas have targeted BlackRock. This was from an FT article today. Republicans in Texas have targeted BlackRock as hostile to fossil fuel, and the state treasurers of Louisiana, West Virginia, and Arkansas have collectively pulled out about $700 million, it's not a huge amount, of investments. Now, BlackRock is $8-9 trillion of assets under management. So 700 million withdrawn by these three states doesn't really, kind of rattle the ship. But if any of those investors own shares of any of the companies of the directors or company secretaries who are on this call, you can expect some of those investors to perhaps change how they vote. It won't allow BlackRock to vote on their behalf if any of them still have money with BlackRock. Democratic politicians, conversely, including New York Controller Brad Lander, complain that how can you be BlackRock? You can't win on either side. They're complaining that BlackRock is failing to match its rhetoric with concrete actions aimed at pushing companies to address climate change. So on one end of the spectrum, you have companies pushing BlackRock to do more to hold companies to account. And on the other end of the spectrum, people are pulling money out of BlackRock's hands, saying that you shouldn't be making decisions based on ESG specific matters. I'll pause there. I'm sure there's lots of questions. Happy to answer anyone's issues, and I know we have more slides. I think there's a few more slides to cover as well.
Thank you, Cas. I think we do have questions coming in. I really do want to sort of make sure that we've got the time for those questions. And I think, the point that you raised, I asked you to look forward, and you can see how complex decisions are made more problematic by tribal sort of alignment, and it is a worrying, that polarization is indeed worrying. If we could go to the next slide, please, Belle, and we'll move on to Q&A. Please do send further questions. I'm going to kick off with a question which goes back to the ISS and Glass Lewis recommendations on resolutions. And the question is, how can we, as board members, make sure that ISS, Glass Lewis are properly briefed, so they've got the information that they need, or is it a question of engaging on the sort of buying the other services side? And maybe just a couple of points that we flagged at the very beginning. I mean, we do see boards really focusing on the quality of IR, making sure that you've got sort of CEO, CFO, if you're a large company, an IR capability that understands how this works and can engage appropriately. I think also the quality of any company's communication with its shareholders and fit into that as well. And I guess also just the focus at board level. So these issues do need to be on the board agenda. So those are some pointers. But Cas, let me hand over to you and any thoughts you have on the what's effective engagement vis-a-vis ISS and Glass Lewis.
So it's a great question, and I had this situation last week where a client said to me, "Oh, I received an email from someone at Glass Lewis, and I've organized a call for next week." And I said, "Oh, can you just let me know who you're meeting with or speaking to?" And they told me, and I was like, "Okay, that's a salesperson for the issuer services. That's not the analyst who wrote or will write the report for your company." So the first point is make sure you're engaging with the relevant analyst at both ISS and Glass Lewis. If you're getting approached by someone at Glass Lewis, I almost guarantee you that it's a salesperson, because the analysts are so busy writing and generating research notes that they don't really have time to do proactive outreach to companies. In specific instances, but rare cases, they will. For the vast majority of cases, their head is down, they're writing research reports, hitting publish, moving on to the next one. It's real assembly line type activity. So the first point is make sure you're engaging with the right analyst who's actually writing the research report. If you're having a problem getting through, there's, feel free to give me a call or I can get one of my team to help you. This is something that we do all the time. We're a client of ISS and Glass Lewis as a proxy solicitor. So we have access and know who the relevant analysts are, not only because of our status as a client, but because we deal with ISS and Glass Lewis on so many corporate matters. So it's important to engage with the right people there. It's very different. ISS and Glass Lewis are selling services to corporates. ISS is actually selling an advisory service. Glass Lewis is just selling their research reports and their report feedback service. The report feedback service allows you as a corporate to append a statement, I think it's up to 7 or 8 pages long, to the back of their research report. And any investor who gets their research report will see your addendum to that, and you're making a case as to why shareholders should not listen to the Glass-Lewis recommendations, but instead follow your suggestions. I can tell you that those reports, while they do get into the right people's hands at the investors, they're not always impactful in terms of trying to get them to support you, and they're only going to people who are kind of using Glass-Lewis. If an investor gets ISS and Glass-Lewis, they'll still see your rebuttal, but if there's different reasons why ISS is voting against or opposing something than Glass-Lewis, you need a different set of arguments to address ISS. So you're probably better off writing your rebuttal letters directly to those shareholders and voting decision makers. I hope that answers the question.
Thank you. That was very helpful, Cas. And we're getting lots of questions in. And I know Alistair had a question as well. Alistair, can I just hand over to you for your question, and then I'll circle back to the participants.
Yeah, sure. It was really just the last slide that you were showing about the rise in the US of the kind of anti-ESG movement, which is not something that we've really seen, particularly here in Europe. Do you see that kind of trend coming over to Europe? That we're going to start to see a significant number of anti-ESG resolutions coming from activists on this side of the Atlantic?
I certainly hope not. I genuinely don't think we will. But don't forget, the U.S. is the largest capital markets in the world, and every company on this call will have shareholders who are based in the States, maybe asset managers based there, but certainly providers of capital, beneficial owners, pension funds who are US based, because they're such significant investors in the UK. So we will see an impact indirectly through some of those state pension funds and how they direct either assets to different managers or how they vote at shareholder meetings. It's not going to be a wholesale shift where BlackRock, because it's a US incorporated, US listed investor, is suddenly going to change stripes. Not at all. It's their clients who will likely decide, a change of action is required.
Thank you. And yes, I mean, let's absolutely hope that we that some of those issues remain on the other side of the Atlantic. I'm getting a lot of questions, so I'm going to bundle some of them together. One set of questions is around particularly the Glass-Lewis recommendations. One question is there a difference, particularly on REM, between voting recommendations for German companies and for UK companies? And then there's a broader question about UK versus US companies. So different types of recommendation, Cas.
Sure. So I would say that the US recommendations has very little corollary with the UK recommendations. It's a different set of analysts at both Glass-Lewis and ISS. And I wouldn't draw any conclusions on their recs in the US. What I was showing was how they were recommending in the UK specifically. So just on the US-UK difference, on the UK versus Germany difference, there's a key development, obviously, in Germany, where last year and this year is going to be the kind of the first foray into say on pay votes or remuneration votes, whereas they've existed in the UK for a while. REM reports and REM policy has been available as a votable item for many, many years. It's being rolled out in Germany, and I think companies there are worried and want to better understand what the expectations are of their shareholders. So, a REM consultation should not only be talking to the heads of governance at your largest shareholders, you should be doing some analysis on what do you expect the proxy advisors to do? What have the proxy advisors supported or opposed, either in the UK or other European markets? And we can certainly help and provide some insights there.
Thank you. We have a question about passive funds and what this does to engagement, and the fact that quite a lot of any shareholder base can be owned in passive funds. So, I mean, what we've seen is that often those passive funds will have an ESG team, and so on. There's a high level of engagement with the ESG team. But Cas, if I can hand over to you.
Sure. So it was Glenn Borum from Vanguard a number of years ago said that proxy voting is the airbag and the seatbelt in the car that protects them as investors against a car crash and getting injured. They are active voters. They typically vote. Passive investors, this is. They regularly participate. They vote all of their shares. Only if they don't, it's only because a client has expressly told them not to for some reason, or the cost of doing so is significant, not relevant in a UK context. So all of the governance teams at the passive investors regularly vote. There's a very significant difference. BlackRock is something like 60 people around the world, a big team here in London that looks after the UK market and Europe. You don't have that size team at State Street and Vanguard. Vanguard now has somebody in London. State Street has somebody in London. But they've lost a couple people. So it's a revolving chairs of contacts and analysts in the governance teams at these asset managers. They go from one shop to another and you just need to stay on top of it. I will say that all of the passives have teams dealing with proxy voting and governance issues.
Thank you. The next, yes, it's interesting, isn't it, that we tend to think of passive as not engaging, and in fact, on a number of issues, they'll be much more engaged. A question here, Cas, what is on the horizon at present concerning regulation in the UK on proxy access rules? So I wonder if you can look forward and just give us your perspective on that.
Sure. So I just want to clarify, proxy access in this context is, I want to make sure I'm referring to the same thing, the company's ability to see drafts of the proxy advisor reports before they're published to clients. If that's the question, I can talk to that. I just want to.
That's my understanding, and
right.
And please, you'll know who you are, and do use the Q&A function but that's my understanding. So, Cas.
Right. So it's always amazing to me how ISS and Glass Lewis, mostly ISS, kind of share drafts reports today, and part of it is driven by how many clients they have in a stock, because they don't want to appear as an outlier, as a recommendation provider. So in many instances, it's not all of the market, they do provide drafts of their report to the companies for them to review, and they give them anywhere between 12 and 24 hours to review it, not just in the UK, but in other jurisdictions as well. Sometimes it's down to the analyst who writes the research to make that determination. France, it's actually set out in law, so it's happening there already. I see that this is something that's going to happen more, but here's the challenge. If the analyst doesn't know exactly who to go to, and they just send the draft report to the IR bucket email address or the CompSec email bucket, it just sits in a bucket and no one picks it up in the time frame needed. And so that can be a real challenge. I've seen that happen a few times.
Yeah, a message is coming through very clearly, really sort of understanding, being on top of this. And I think it probably, it's easier for larger companies to have that resource to stay on top of this. It can be very difficult for smaller companies to dedicate the resource here. That's coming across very clearly. Cas, I'd like to just come back to the whole point of the whole discussion around climate change. I thought it was very interesting that almost push towards policies and being and shareholder resolutions, and now I guess a more nuanced understanding, and probably we are going to see a lot of progress being made in how companies report on their pathway to net zero, and so investors will have more information, companies will have more information. What is your overall sense of where we'll end up? Will this be a topic for shareholders to vote on specifically, or do you think, given the sort of almost the growing complexity and importance and scope, that actually it'll just become embedded and captured in non-financial reporting and as part of the overall performance of the company?
So it's a challenging question, right? Because in the first 2 years, say on climate transition plans, it ranged in terms of what companies put forward to their investors to approve, in terms of how detailed they were, how committed the companies were, and more importantly, what were the metrics for remuneration tied to, in terms of achievement of some of those goals. I think what investors have done in the last 2 years is start to crystallize what's important to them, from a climate transition plan for companies, and they're going to be far more critical of companies that aren't providing the clear metrics and details of what that plan should include from an investor perspective, not from the company perspective. So it'll be somewhat prescriptive, and for companies that don't, I could see them getting much lower vote supports than what we've seen this year. And you know, it all comes down to how the companies respond to some of that, and if the corporate world kind of moves along the same journey as the investors and are more proactive and more detailed in that reporting, it doesn't necessitate that it's going to go down, but if that doesn't happen, I can see a big backlash.
Thank you.
Bigger backlash.
Thank you. And I'd just like to come back to another sort of dimension, perhaps, of ESG, diversity. Now, in past years, we've seen quite strong investor engagement around particularly increasing gender diversity and also ethnic diversity. Just your views on you know, where, and I guess it's particularly at board level where investors do actually have the direct say, but just your views on what's happening in the diversity space within for investors.
I think diversity will remain a core theme for investors going forward. I do think next year that issue will be eclipsed by more broad-based questions on looking after the general workforce and the economic crisis, the environment that we're now in, whether it's inflation, you know, mortgage rates going up, you know, there's a variety of issues that I think is going to usurp diversity as a primary issue. I think it will be a secondary or tertiary issue. And how companies look after their workforce is going to become a far more significant issue over diversity.
And do you think that will translate into, you know, if there's dissatisfaction, investor dissatisfaction, that you know, if you look at the UK, where you have a designated NED, and in many companies have opted for that structure, that they'll appoint a NED as the employee engagement NED, that we'll be seeing negative votes directed at that particular director? Is that how that could express itself through the AGM?
It could. I don't think it will. I think it will probably find its way towards the chair of the REM committee. And because this is all about economics for the workforce, the labor, and the management and the board. And if there's a challenge to the workforce, they'll look at how the board treated themselves, how the management treated themselves, and probably, I would imagine, kind of land there as opposed to focusing on the NED.
So still that remuneration focus, perhaps from a slightly different angle.
Correct.
But yeah, no, thank you very much. Cas, you've provided us with great insight. I'm watching the clock. I am going to wrap up. So thank you very much. And I'd just like to pull together some of these thoughts. So Belle, if we can move to the next chart, please. Just some of the sort of observations. One, that the AGM is obviously where shareholders can really influence and direct companies. REM is, I mean, Cas talked about that very clearly. It's been a focal point. It will probably continue to be a focal point, particularly as we look towards economic hardship. The pathway to net zero is firmly within investor sights. And we're seeing shareholders getting better at assessing progress, as well as companies becoming more explicit about how they're thinking and measuring progress. We, as Fidelio, clearly see evidence that shareholders want to see ESG being embraced within the company. So, for example, very often, you know, the committee, the ESG committee, will be perceived as you know, an action on the part of the board to embrace ESG, and this isn't sort of instead of performance. It's absolutely, performance still has to be there. So it's not an either or. It's clearly not either or. It's companies moving towards embracing these other expectations, as well as the underlying financial performance. So thank you very much, Cas, for really walking us through that. And I should say that your charts, which are quite small, we will share them to everybody so that you'll be able to get your magnifying glasses out and look at the detail, because there's a lot of detail in there. We've got a number of webinars coming up, including financial regulation meets climate change, consumer duty and board responsibilities, both in October. And then in November, we're looking forward to gender, power and influence in the boardroom, with a sort of a fairly star-studded cast. So we look forward, and invitations will flow. We look forward to you joining us for these events. We'll share the charts with you and the follow-up. But on that note, I'd really like to thank Cas enormously for sharing your insights, and we will share your report as well, and Alistair as well for joining me on this call. Thank you all very much indeed. It's been a real pleasure, and we look forward to welcoming you again soon. And if we can support you in any way, please do get in touch. Thank you very much indeed. Thank you.
Thank you.
Bye-bye.